Who doesn't like to create wealth? But the big question is, how do we create wealth? Where do I invest? Well, in today's Investors Hangout, we'll give you an investment roadmap to create long-term wealth. With me is Dhiren Kumar, CEO of Value Research, and this episode is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Dhiren, welcome.
Thank you.
It's a big burning topic that we are talking about. मुझे wealth चाहिए, but मैं wealth कैसे create करूँ?
Building wealth is it's actually not optional. It is compulsory because you are going to live longer. You should be able to accumulate your savings or build wealth to the tune that it will last beyond your lifetime. Because if you exhaust all of it while you're alive, running the risk of spending all your savings in your lifetime is will cause distress. So I don't think building wealth, whether it's an optional thing or you can't do without it. And the changing dynamics of our expenditure, of our expenses, and the way the inflation has been, the way inflation will be in future, the way our individual inflation will be, the cost of healthcare, the cost of living longer, because if the average mortality was assuming 65 or 70, and that is going towards 75, 80 with better healthcare and other things, so you simply need more money to sustain yourself in your retirement. Your retirement phase is going to be longer. So you need to build wealth. How to do it? Same old principles. Save as much as you can. Save as much of it in equity for the longer period. The long-term money, the money which you don't need for next 5 years and more, should be in equity. Invest regularly. And if you are scared, many investors still in India are not, reconciling. Then, they are not appreciative of the necessity to invest in equity. And today we have, all the desirable vehicles to deal with it. For example, you're a first-time investor. You are scared of equity. You don't want to invest in equity. Still, you have to. So get started with equity saving fund. Only 1/3 of your money is going to be invested in equity. If you are going to invest regularly, you will reduce the risk of losing your capital substantially. That apart, 1/3 will actually give you a reasonable experience that why you should not be scared of it. And once you have done this for 3 years, you will understand. Then upgrade yourself. Then move to the balanced fund, which is 50% equity, 50% debt. We don't have too many good balanced fund. It's still, it has been mandated by the law. So maybe invest with the aggressive hybrid funds. These funds are 2/3 equity, 1/3 fixed income. So it is a steadier take. So you don't have to necessarily invest all your money in equity. You can start conservatively, move to more aggressive vehicles. Then after 3 years, move to multi-cap, move all your money to multi-caps and continue investing more. So if you have this principle that a part of your saving is getting invested, you are increasing your savings and you are investing in the appropriate vehicle so that you are not getting driven out of the market out of fear or on a decline. And if you keep doing this for 15, 20 years, you will build wealth. And you will build, and having more than enough is critical because and that is the only insurance against the risk of outliving your savings. Because if you don't do that, if you don't have more than enough, the changing dynamics of expenses, what happens if we actually in 50 years time we start living for 110 years? It's going to be a nightmare of a kind. The good news is that there's a possibility that we'll live that longer, and the bad news is that we may not have the money. And you will not be in a position to work then. Sure. So it's important to build wealth. It's important to get started. There are vehicles to do that. Start with equity savings if you are the scared kind, fearful kind, apprehensive and suspicious of equity. get into the aggressive hybrid fund after 3 years, get into multi-cap funds after 9 years, then get into small and mid-cap funds, put 20% of your money in small and mid-cap funds after that. All this is possible only if you have time, only if you have, you're investing for 20, 25, 30 years. And once you get, and if you have the time, if you have the inclination, invest in stocks directly as well. But it's important that you should have time, you have the understanding, and you also have the temperament, because investing in markets directly requires orientation, understanding, knowledge. And most investors who dabble into stocks directly, they get into the speculative mode that quick returns. If you are deriving it, if you accidentally get started at a point where you are able to realize substantial gain, then you tend to get speculative. You don't become a long-term investor. You may not have the temperament, and maybe riding the up move might be easy. Reconciling with a fall might scare you out of the market. So choose your vehicle, get going, start investing, be regular, and equity is the only way to build wealth. Because if you are looking at fixed income, you can be well off, but you won't build wealth. Equity is the only thing which can potentially build wealth, because the difference is that fixed income will yield you anywhere between 6 to 9% over the next 20 years. Maybe less, maybe more, and taxable. And equity will get you 1.5 times to twice as much, and the compounding at that pace itself will build wealth.
Right. In our last episode, you mentioned about the importance of starting early. So that whole
starting early is just as important, because the power of compounding, the magic of compounding, that requires time. So if you are starting, think of it. If somehow I am able to build, assuming that I double my money every 5 years, and in 20 years' time, I'm able to accumulate 1 crore rupee. And in 20 years' time, I build 1 crore rupee. Somebody who started 5 years early, he will be able to, he will have 2 crore rupee simply because he started 5 years ago. So, compounding works, and the benefits are not visible. And the joy of consuming money today is too tempting. You have just too many things available around, and you tend to spend it. But the power of compounding, the value of time, and starting 5 years ago before another person, you will understand that doubling your money every 5 years, which is not a very unrealistic thing, has not been an unrealistic thing in equity, but 1 crore and 2 crore for the difference of investing period of 20 and 25 years. So you understand why you need time.
You mentioned a comment that you just made about the joy of consumption. It's so great these days. So there has to be some bit meant for this consumption. So when it comes to investment, should I look at 40-50% of consumption, 10% for enjoyment?
No,
there's no roadmap that way.
I'm not prescribing any percentage, because it varies from person to person.
And the goal.
One is goal. You might have fancy goal, but if you have immediate consumption need of 100% of your income, you won't save. You can actually, do some planning around it. For example, having a health insurance is important, because that will not derail your savings plan with you being unwell or a family member needed a cost. So that's one thing. Besides that, I think it's more a matter of discipline. If somehow there is a need for you to actually consume all your income, you can have a situation, you can have a circumstances. You have a family, assuming that you need to support your parent, and your income has come in handy to support that. Maybe you may not be able to save any money. Save 100 rupees. Whatever it is, because initial 3, 4, 5 years is more a matter of taking the lesson that how compounding works, how a small amount turns into a larger amount, and a larger amount, because when you are not able to save anything, even that 100 rupee or 250 rupees or 500 rupees will get you the cushion of 6,000 rupees in a year or 5,000 rupees handy at some point. So that is more of a learning phase. I think you are just going through that phase. So do that, fall in habit of that. If you can't invest in mutual fund, do your recurring deposit.
Okay.
Because having money which you may not have otherwise, and that is in fact that having that 6,000 rupee with your 500 rupee monthly saving will be far more valuable at a time than having maybe 50 lakh rupees 7 years later, when things would have changed. Your earnings will be supporting a higher spending. Despite that, you are able to save more. So initially it's learning.
Okay.
Fall in habit.
That's very well said. In the Indian scenario, we've been taught that, okay, घर में gold रख लो, तुम wealthy हो गए. So what do you have to say to that? I mean, is gold an investment?
Gold is a repository of value. It is valuable. It does not go down in value, but it does not generate wealth. It does not build wealth. And more so, if something happened to gold about 10 years back, the financialization of gold ETFs got created, gold funds got created, and a lot of investors, and then it coincided with the global financial crisis. For the first time in the world, the whole world was shaken by the decline in stock values, decline of bonds. For the first time, the money market fund in America did break the buck. So it went down in value by, the face value was 1 rupee. It never used to go down. It went down. So there was scare all around. And that is the time, and this financialization of gold was relatively new. So it just took off, and a lot of people started thinking that gold is an investment. It's not an investment. It is a store of value. It preserves it. It does not necessarily even preserve its value. So think of gold as a consumption. Think of a gold as a very emergency thing, as a store of value which can be put to use in emergency. But the way we consume it, the way we spend money on gold, you should have it to the extent of what is needed in the customary thing.
Okay.
Nothing beyond that.
Okay. What about stocks? You did mention about it. Should one invest in them? How do they fare vis-a-vis the equity?
No, you are investing in equity mutual fund. You are buying shares.
But on our own, can we get into stocks?
You should.
You should.
If you can. But if you can is a big question, because for most investors, they need time, they need interest. And the only thing which works in stocks, investing in companies directly, is choose a good company and have the patience to hold it.
Okay.
And keep an eye on that company, so that you have chosen a good company, and when it turns bad, you are able to anticipate that. Right. And on the way, there'll be a lot of noise. For no reason, many times the stock price will go up by 50%. Many times the stock price will go down by 50%. And you will have to build the technique of spotting that what is noise and what is bad news. It is a hard thing. It's a difficult thing. It requires practice. So maybe you will start small.
Okay.
Understand this thing. Don't speculate. In fact, avoiding speculation and not getting carried by the noise, because most stock investors tend to buy something based on very frivolous, rational. They don't understand. You have to think like an owner when you are buying a stock. Businesses don't get built overnight. It takes time for business to find its feet, get meaningful, get useful, and be good for customers, and then it has been able to devise some mechanism so that it succeeds and keeps prospering and growing. That takes time, and somebody should be watchful of that. And in between, you will have all these distractions that sometimes the stock price movement is not corporate performance. Stock prices go up because when companies make money, stock goes up. When stock price goes up and the company is not making money, or company is making money and the stock price is not going up, that creates opportunity. That creates opportunity to buy or sell, or take a call on that. Investing for the long run, investing for the long run with understanding, keeping an eye on that. If you have all this time, inclination, and the temperament, then go for it. Else not.
Okay. So Dhirendra has given you the mantras: invest for long term, invest in equity, invest regularly, and if possible, invest as early as possible. Okay, so Q&A is what we have next, and Joseph has written in saying, should I opt for a perpetual SIP?
Yes, please. Do that. But at the same time, perpetual SIP can also be cancelled. And if you invest in a fund, which is
It's in your hands.
it's in your hands, so
Okay.
it's good to actually start a perpetual SIP. Maybe it's good to start your perpetual SIP with a standing instruction that increase the SIP amount by 5% or 10% every year. Because perpetual SIP after 10 years, if you start with 5,000 rupee, that 5,000 rupee will look very small amount 10 years later. So if you are able to do it with a top-up SIP or a rising SIP with times, that will be a better idea. And if that fund for the fund which you have chosen turns out to be disappointing, it can always be cancelled and you can move your money elsewhere and start your SIP elsewhere.
Okay. Shipra says, is it fine to book some profits from my equity mutual fund investments?
Booking profit actually presents a challenge that what do you do with that booking? So if you need the money, book the profit, take the money out. If you have succeeded with your investment and if you are able to actualize your goals, by all means. Otherwise, just because the market has gone up, no. In fact, I would like to give you an example, a time period which was not very long ago. 2003, the market was at 2800 on the Sensex. It went up to 4000 by 2005 or so, and went up. So this was doubling of money. Then it went up by 1000 points, and every 1000 point, that was the headline. That was actually the flag. Even live TV was relatively new then, so it was big news. Every 5-6 months we had Sensex climbing by 1000 points, and it will be the headline of even the mainline newspapers. So people who invested at 2,000, 3,000 points got out at 4,000. That okay, this is more than enough. Then 4,000 became 5,000. Then the same people came back that it's still going up. Then somebody who invested at 4,000 got out at 6,000, and the market did not stop till it attained 20,000. So most people who are jumping in and out would have missed out. But at the same time, I would like to give you the context that how did it happen. Before that, the market was going up and down for nearly 8-9 years, and so booking profit is not the mantra. The mantra is for an individual investor is invest your long-term money, set your asset allocation. Setting your asset allocation will actually translate into booking profit. If you have decided to invest 50% into equity, 50% into debt, equity goes up, you will book profit and put money in fixed income. But by the same rule, when equity does poorly, you will take money out from fixed income and invest in equity once again. So if you are going to follow an asset allocation guided booking profit and investing again, then by all means do it. Otherwise, if you are investing for a distant goal and doing your SIP, don't book profit just because you think that the market has given enough. We don't know. Markets go up and go down, and sometimes they go up dramatically and go down dramatically when we least expect it.
Anshul says, I'm planning to buy a house with the help of a bank loan. How can I decide on the budget? I'm a little intrigued by the question.
These are actually personal choices, but I would say that if you are confident of not getting fired from your job, then there are 2-3 things which one should keep in mind. One is that buying a house, will it translate into saving of your rent? So that is an immediate benefit. So you will save money elsewhere and it will go into building a capital or having your house over time of your own. So that's one. I would say that most conservative approach should be that at least having 25 to 40% of the down payment, making the down payment. So if your house is worth 1 crore of rupees, I'm just saying 1 crore for ease of mental calculation. So you should have 25 to 40 lakh which you put, which is your own money. So you borrow the rest of it. And the EMI for that, the borrowing, whether it is for a 10-year period or 15-year period or 20-year period, depending on the length of your job and how confident you are of holding your job or growing or prospering in your job is that your EMI, the installment of your loan, should not be more than 25% of your income. And it should not definitely exceed 33% of your income. So if you follow these two rules, that it will save on your rent, which means you are in some foreseeable near future, you are going to live in that house. You should have 25 to 40% of the down payment, and 1/3 of your income is not going to repay the loan.
Okay.
Go for it. That should be the budget.
Okay. Sujan says, which debt fund category should I choose in the current interest rate scenario?
I think for most individual investors in any rate scenario, for your very short-term money, your choice should be liquid fund and ultra short-term bond fund.
Okay.
These are funds, where the likelihood of losing money is not there. You can take your money out anytime. In fact, in the liquid fund, you can take 50,000 rupees at a couple of hours notice. So you make a redemption request on your app and you get the money in maybe sometime between half an hour to 1 hour in your bank account. The money hits your bank account. So you can do shopping with your liquid fund investments with a debit card. With that apart, and for most other investors, short-term bond fund is good enough. Don't choose the gilt fund. Don't choose the dynamic bond fund. More so now and generally ever, because the rewards of fixed income, the Indian fixed income investor, the medium-term fixed income investor, is not reconciled to the idea of decline in value. If you invest a lakh of rupees, and if that money ever becomes 98,000 rupees, you are not prepared for that kind of decline in value, which can happen and which often happens. And it often happens when you are generally expecting a high return, because the payoff of a fixed income fund is not very large. You are never rewarded with substantially high return. But this decline in value is not something which investors ever expect. So it is extremely disappointing.
Okay.
So eliminate the possibility of great disappointment. Make sure that you are in a kind of fund which will not disappoint you and will also not reward you substantially. You will end up with little better return than what you earn in deposits. It will be tax efficient. It will also be more liquid.
Next question is from Girish. He says, will it be wise to invest lump sum in equity saving funds now and do an STP in aggressive hybrid funds over the next 1 year? I'm a conservative investor and want to protect my capital.
I would say that, it doesn't matter much. Doing this, you will have to worry about. There is a problem in this method. The problem is that most equity savings fund, they invest 1/3 of money in equity. They will also have an exit load for redemption within 1 year. And I think most of them have a term that up to 10% of your money can be redeemed without any exit load. So you will be liable to pay exit load. That apart, even averaging your money in an equity fund, in an aggressive hybrid fund, you are basically averaging. And the two vehicles from where you want to invest and from where you want your money to eventually land into, I would say keep it simple. Put it in a fixed income fund and move that money into an aggressive hybrid fund over the next 12 months. This will fulfill your objective, because even equity saving fund will go down in value sometimes. And that is something which you will not be able to reconcile with. The whole idea is to ensure that you are averaging your investment, you are eliminating the possibility of catching a market high. That apart, making sure that your principal, which is getting invested in equity, does not go down in value. And this exit load problem, that 1% of your money will will be charged as exit load, is definitely it's an undesirable option.
Okay. I have a lump sum amount of 40 lakhs, writes Himanshu. Currently, it is parked in fixed deposit and I want to invest this amount in mutual funds. What strategy should I follow?
Watch our last episode.
Yes.
Because the last investor hangout session, because there are too many things which is dependent on you. If you have never invested in a mutual fund, if you have never invested in a mutual fund which has anything to do with equity, I also don't know how important this money is. if this 40 lakh rupee is something which comes your way every couple of years, then spread this investment over next 12 months. If this 40,000 rupees is something which is once in a lifetime kind of money, and you are unlikely to need this money for many years, then invest it over the next 3 years, averaging this investment over this period. So invest this money in a fixed income fund, and from there you do your STP over the next 3 years if it is that money. Your fund selection should be different if you want to invest this 40 lakh rupees to generate some periodic income for you on which you will be dependent on. That requires a different vehicle.
Jagdish says, I have been investing in mutual funds regularly over the past 2 years. Instead of SIP route, I invest multiple times in a month whenever the market falls, and the returns have been good so far. Am I right in doing so?
You are lucky, or you are a genius. I don't know, but I think a good part of your money, if you are able to formulate a rule around this, that you will definitely invest every month irrespective of whether you are able to perfectly time it or not, then it's fine. You are having fun and feeling happy about it, but ensuring that there is a degree of consistency of investment or regularity of investment, then it's okay. Otherwise, for most simple people, the simplest approach is define a day and the money should be out of your bank account. I don't know if it's the perfect timing or not. Because the real risk of trying to time your investment every month is that some months you will not invest because you will wait for the market to correct. Because there are, last 2017, the market didn't fall in any of the months. So what do you do then? Do you stop investing? So having some essential
that will be detrimental for him.
That will be, because you'll be deprived of the big moves.
Yeah. Arun says, I invested in a fund for 10 years. Now I find that it is not doing well and I need to switch. What do I do with the amount that I have accumulated? Do I switch to a new fund in lump sum, or should I again start an SIP?
No, once you find that the fund that you chose and you have been investing is not doing well, you should stop your SIP. Not only stop your SIP, move your money lump sum in the new fund, the one which you have chosen or you think is going to be promising from here on. Simply, the whole idea of SIP is that you are able to average your investments into equities, but all your money is invested in equity already. So moving all your accumulation into the new fund, as well as just be careful about the exit load and the short-term capital gains that will be, or even long-term capital gains. But there won't be any substantial long-term capital gains for investors, because all the gains will be on the gains after 1st February 2018. So there may not be substantial gain. So it is about time to, if you have decided about your prospective fund where your money should be invested, move your accumulation and your new SIP to be initiated in that fund.
Dhiren, that's all we have in today's episode. Remember what Dhiren said, early bird catches the worm. So the time to invest is now, and invest regularly. Till we meet next time, it's goodbye from Dhiren and me, Rajesh Lake. Bye for now.